Welcome to DWS Market Update. Capital markets performed exceptionally well this year, despite all the political turmoil. European investors earned particularly well on European stocks. US stocks also performed very well, but European investors saw little benefit in euro terms due to the strength of the euro. Before we address the question of what lies ahead for markets, let's briefly summarize our economic forecast. We expect growth of around 2% in the US and above 1% in the euro area in the coming year. Inflation rates in the US are likely to remain slightly elevated for a while due to tariffs, while we expect inflation in the euro area to remain largely at its target of 2%. In our opinion, the ECB should leave interest rates unchanged. We expect the US Federal Reserve to cut key interest rates 3 times. This has already been largely priced in by markets, so we do not expect any major movements in medium or longer-term yields. All in all, the economic outlook is very constructive. What does this mean for investors? Good growth, moderate inflation, key interest rate cuts, and stable yields are helping the stock markets, especially as long as AI companies deliver on their promised profits. Therefore, we assume that the positive development in the US market should continue and expect a performance of above 10% by the end of next year. However, we too are increasingly concerned about the growing concentration of the US market on a small number of companies. In this context, we recommend diversifying equity investments internationally. After all, we expect the DAX and other European indices to perform in a similar fashion. Diversification into other asset classes, such as US government bonds or European corporate bonds, is also a good option. Naturally, the expected returns here are not quite as high, but they are still reasonable, and a broadly diversified portfolio usually shows significantly less volatility. With this constructive outlook, I say goodbye until next time.